Imagine this. You've spent the last 30 years building your retirement. Every paycheck, a little money went into your 401k. You stayed invested during market crashes, during recessions, during years when your portfolio barely moved. And after decades of patience, your balance finally reaches $300,000. Then life changes. Maybe you retire. Maybe you find a better job. Maybe your company restructures and your position disappears. Whatever the reason, you leave your employer. Now it's time to decide what happens to your retirement savings. So you call your company's retirement department. You tell them you'd like to roll your 401k into an IRA. They process the paperwork. Everything seems straightforward. Then, about a week later, a check arrives in your mailbox. You open the envelope, and immediately, something feels wrong. Instead of $300,000, the check is only for $240,000. $60,000 is missing. Your first thought is probably the same one almost everyone has. Did someone make a mistake? Did the company keep part of your money? Did the bank charge huge fees? Did something go wrong during the transfer? The answer is no. In many cases, exactly what happened was supposed to happen. And that's what makes this so dangerous. Every year, thousands of people unknowingly make expensive mistakes simply because they don't understand how a 401k rollover actually works. Some accidentally create a taxable event. Others owe penalties they never expected. And some permanently lose thousands of dollars that took decades to save. The scary part is, most of these mistakes are completely avoidable. All it takes is understanding a few important rules before moving your money. So before you roll over your 401k, let's look at what can go wrong and, more importantly, how to avoid it. A simple decision. Or is it? When people leave a job, they're often told they have several options for their old 401k. They can leave it where it is, move it into their new employer's retirement plan, roll it into an IRA, or cash it out entirely. For many people, rolling the money into an IRA sounds like the obvious choice. It gives you more investment options. It puts all of your retirement savings in one place, and it can make your finances easier to manage. But here's something most people never hear. There isn't just one way to roll over a 401k. There are actually two completely different methods. They may sound similar. They both move money from one retirement account to another. And they both can end with exactly the same result. But everything that happens in between is completely different. One method is designed to keep the process simple. The other creates several opportunities for mistakes. Understanding the difference could save you thousands of dollars. Two paths, very different outcomes. Let's simplify it. The first method is called an indirect rollover. The second is called a direct rollover. At first glance, they don't seem very different. Both begin with your old 401k. Both end with an IRA. But the route your money takes changes everything. Think of it like flying to the same destination. One flight is non-stop. The other has multiple layovers. Every additional stop creates another opportunity for delays. Another opportunity for something to go wrong. That's exactly how these two rollover methods work. One is almost automatic. The other depends entirely on you following every rule perfectly. Let's start with the one that causes the most confusion. The indirect rollover. Here's what happens. Instead of sending your retirement savings directly to your IRA, your employer sends the money to you first. You receive the funds. You deposit them yourself. Simple enough, at least that's how it appears. But the moment that money is paid directly to you, the IRS sees the situation differently. Remember, the government doesn't know what you're planning to do next. Maybe you're moving the money into another retirement account. Or maybe you're withdrawing it to spend. They can't read your intentions. They only know one thing. Money just left a retirement account, and because of that, federal law requires your employer to hold back part of the distribution before sending you the money. This surprises people every single year, because almost nobody expects it. Where did the money go? Let's go back to our example. Your retirement account contains exactly $300,000. You request an indirect rollover. A few days later, your check arrives. But instead of receiving $300,000, you receive only $240,000. The missing $60,000 didn't disappear. It wasn't lost. And it wasn't taken as a fee. Your employer was required to send that money directly to the ears as mandatory federal tax withholding. It's essentially a temporary tax payment. The ears is protecting itself in case you decide not to complete the rollover. From their perspective, the money has already left the retirement account. Until proven otherwise, it could become taxable income. So they withhold 20% automatically. This is where many people panic. They immediately assume something went terribly wrong. They call HR, they call their brokerage, they call their accountant, only to discover everything happened exactly according to the rules. Unfortunately, that's only the beginning of the story. Because once that check reaches your mailbox, another rule quietly starts counting down. And that countdown determines whether your rollover stays tax-free or becomes one of the most expensive financial mistakes you'll ever make. The clock starts ticking the moment you receive that check. A countdown begins. And this countdown is one of the most important rules in the entire rollover process. You now have 60 days to move that money into an IRA. Miss that deadline and the IRS may treat your rollover as a permanent withdrawal, which means taxes, and in some situations, an additional early withdrawal penalty. But here's the part that catches almost everyone off guard. You're not required to deposit the amount you actually received. You're required to deposit the entire original balance. Let's go back to our $300,000 example. Your employer withheld $60,000 and sent it to the heirs. You received a check for only $240,000. If you want the rollover to remain completely tax-free, you must somehow deposit the full $300,000 into your IRA, not $240,000. The full amount. That means you need to come up with the missing $60,000 from your own savings. Only after you file your tax return and prove that the rollover was completed correctly can the IRS return that withheld money as part of your refund. But that refund doesn't arrive in 60 days. It may take months. And that's exactly where many people run into trouble. When things go wrong, imagine you've just left your job. You're starting somewhere new. You're updating insurance, changing payroll, learning new responsibilities. Maybe you're moving to another city or adjusting to retirement for the first time. Your attention is already being pulled in a dozen different directions. Now add another challenge, finding $60,000 in cash. Not because you want to spend it, but simply because the rollover rules require it. For many families, that's impossible. So they deposit only the $240,000 they actually received. Unfortunately, the IRS doesn't see it that way. As far as the IRS is concerned, the missing $60,000 never made it back into a retirement account, which means it's treated as money you withdrew. You may owe ordinary income tax on that amount. And if you're under age 59, you could also owe an additional 10% early withdrawal penalty. Suddenly, a simple paperwork decision has become a very expensive financial mistake. Not because you broke the rules intentionally, but because you didn't know they existed. The better option, fortunately, there's another way, and for most people, it's much simpler. It's called a direct rollover. Instead of sending the money to you first, your employer transfers the funds directly to your IRA provider. The money moves from one financial institution to another. You never take possession of it. Because of that, the IRS doesn't require the 20% withholding. There's no missing money, no need to replace anything out of pocket. No 60-day scramble. No unnecessary stress. Your entire $300,000 simply arrives in your IRA, exactly as it left your 401k, clean, simple, and with far fewer opportunities for mistakes. That's why financial professionals generally recommend a direct rollover whenever it's available. Not because it's more exciting, but because it removes almost every point where something can go wrong. Don't panic if a check arrives. Here's one detail that often confuses people. Sometimes, even with a direct rollover, a paper check still shows up in your mailbox. That doesn't automatically mean you've done anything wrong. The important question isn't whether you receive a check. It's who the check is made payable to. If it's made payable to your IRA provider for your benefit, it's still considered a direct rollover. You're simply delivering the check. The money never legally belongs to you. So don't deposit it into your personal bank account. Don't leave it sitting on your kitchen counter for 2 weeks. Forward it to your IRA provider as instructed. Understanding this small detail can prevent a lot of unnecessary confusion. Before you move a single dollar, now that you understand the rollover process, there's another important question. Should you roll over your 401k at all? Many people assume the answer is always yes. But retirement planning is rarely that simple. Before making any decision, ask yourself these 5 questions. Question 1, will you need this money before age 59? Some workers who leave their employer during or after the year they turn 55 may qualify for penalty-free withdrawals from their employer's 401k. It's commonly known as the Rule of 55. But here's the catch. Once those funds are rolled into an IRA, that exception generally disappears. So if you expect to use part of your retirement savings before reaching 59, rolling everything into an IRA immediately might not be the best move. Question 2, does your 401k contain company stock? Many employees accumulate shares of the company they worked for. In some situations, those shares may qualify for special tax treatment if handled correctly. But once they're rolled into an IRA, some of those tax advantages may be lost forever. If company stock makes up a meaningful portion of your retirement savings, it's worth understanding your options before making any decisions. Question 3. How do the fees compare? Many people automatically assume an IRA is cheaper. Sometimes that's true. Sometimes it isn't. Large employers often negotiate access to institutional investment funds with extremely low fees. If moving your money means paying higher investment expenses year after year, those extra costs can quietly reduce your retirement income over time. Always compare both accounts before making the switch. Question 4. How important is creditor protection? Employer-sponsored retirement plans generally receive strong federal protection from creditors. IRAs also offer protection. But the rules can vary depending on where you live. For many people, this may never matter. But if you're a business owner, own rental properties, or work in a profession with higher legal liability, it's another factor worth considering. Question 5. Do you fully understand the method you're choosing? This might be the most important question of all. Because paperwork isn't the difficult part. Understanding the consequences is. Retirement decisions shouldn't be rushed. Taking an extra hour to learn the rules today could save thousands of dollars tomorrow. The bigger picture every year, millions of Americans leave jobs, start new careers, or retire, and almost all of them eventually face the same decision. What should I do with my old 401k? For many households, this isn't just another investment account. It's the largest financial asset they've ever built. The result of decades of saving, years of patience, and countless paychecks. That's why decisions involving retirement money deserve careful attention. Because mistakes don't just cost money today. They can reduce the income you'll depend on for the rest of your life. Final thoughts. So, here's what you should remember. Not all rollovers work the same way. An indirect rollover sends the money to you first. That triggers mandatory 20% federal withholding. It starts a 60-day deadline. And it can create unnecessary risks if you aren't prepared. A direct rollover transfers the money directly between financial institutions. No mandatory withholding. No missing 20%. No scrambling to replace cash. And for most people, it's the simpler and safer option. But before moving your retirement savings, take a moment to look at the bigger picture. Think about your age, your future income needs, your investment costs, your tax situation, and whether moving the money is truly the right decision for you. Because protecting your retirement isn't just about earning higher returns. Sometimes, the smartest financial move is simply avoiding an expensive mistake. The money you've spent decades building deserves that level of care. And before signing any rollover paperwork, make sure you understand exactly where your money is going and what happens along the way. Because one informed decision today can protect your retirement for years to come. So thanks for watching.